Good afternoon. This is Sean Golding with Golding and Golding, here to discuss the basics of Fbar and tax reporting requirements and compliance. Tax season is upon us again. You're staring at the forms, figuring out why do you have to do this, what's included on the form, and how can I avoid doing it, right? So let's go through the basics. For U.S. persons who have foreign income accounts, assets, or investments, there's two key components to consider. There is the tax and there is the reporting. The United States follows what's called a worldwide income. What does that mean? That means that the U.S. taxes you on your global income. You could be a U.S., let's say, lawful permanent resident. You're living in foreign country A, you're earning all your money from foreign country B. Well, the U.S. still wants to get its hands on it, and so you still have to include all of that on your U.S. tax return. Now, there are various exceptions and exclusions and limitations, treaty elections, closer connection exception, etc., etc. But the baseline perspective is if you have foreign income, it's taxable. Reporting is also a big pain in the butt. There's various reporting you have to do based on your global assets, investments, and accounts. Bank accounts, investment accounts, insurance policies with surrender values, pension accounts, mutual funds. It's all reportable. So let's start with the common tax issues and then go on to the reporting. So tax issues, right? First question we get often is accrued income versus distributed income. Well, what does that mean? Let's say you have a stock account. Forgetting PFICs and mutual funds for a moment, I'll get to that in a second, but you've got a stock account, maybe it generated $5,000 of dividends, but it wasn't distributed out of that account. Well, it's still taxable. Just because you didn't get to touch the money, just because you didn't take it out or withdraw it or have it distributed doesn't mean it's not taxable. If it grew, then it's taxable. And of course, there's some discrepancies to whether, like let's say you have a stock account, that the value of the stock go up or are there dividends accrued will determine whether or not it's taxable or not. If just the value of the asset went up, generally not taxable, right? If you're aggregating income within it so that maybe you're accruing dividends and capital gains, well, that would be taxable. Foreign tax credits. Well, let's say this is all true, but you've already paid some tax overseas. Well, generally you can apply for a foreign tax credit, individuals form 1116. What that means is if you've already paid tax overseas, you may qualify for a credit against your U.S. tax liability. Generally, what will happen is either you'll have too many credits and so that you can carry them forward through a subsequent year, or you won't have enough credits and you have what's called a deficit, and then you have to pay. The difference is typically it's not dollar for dollar, but at the end of the day, most people will benefit from that. If you're living overseas for earned income, now this is just earned income, not passive income, right? The foreign tax credit applies to earned income or passive income, but there's something called the foreign earned income exclusion. And what that says is if you live overseas and you qualify for either the bona fide residence test or physical presence test, you may qualify to have up to about $108,000 of your income excluded that adjusts for inflation. There's also certain housing exclusion. It's normally around $15,000 a year. Works kind of like a sandwich, right? The first part is not deductible. The second part is. The third part isn't. There's a cap. So if you're filing jointly, that's great. I mean, a couple $100,000 could be avoided. You can't double dip the housing, but you can each claim the foreign earned income exclusion. And then if you're sharing housing, for example, well, you can deduct that. One other key concept to keep in mind is that in many countries, Asian countries especially, there's no tax on passive income like capital gains or dividends or interest income. That doesn't apply in the U.S., right? Just because you're not paying tax on it there doesn't mean you're not paying tax on it here. You have to include it, and unfortunately, it could become an issue because people don't have foreign tax credits because tax isn't being withheld in the foreign country. One other issue on the foreign tax credit I see with India a lot, if you're paying taxes overseas or it's being withheld TDS, but then you get the money back, right? You filed a tax return and you got your foreign tax credit refunded, well, that will impact your ability to take those credits in the United States. Let's move on to the reporting issues. When it comes to reporting, the two forms you'll hear about constantly are the Fbar and FATCA. Fbar is the Foreign Bank and Financial Account Reporting. It's filed on FinCEN Form 114. FinCEN refers to the Financial Crimes Enforcement Network. Do not let the fearmongers get to you with that phrase. It's unfortunate, but it's rarely ever that Fbar leads to criminal issues, okay? Typically civil, typically non-willful. Even though it's a FinCEN form, the IRS is tasked with enforcement. I think it was since 2003. And then there's FATCA Form 8938, they work together because FATCA was developed on the U.S. tax return. Form 8938 came into effect around 2011. And ever since that happened, the Internal Revenue Service has significantly increased enforcement of the Fbar, so they kind of work tandem. There's a lot of overlap. Oftentimes, you'll have to file both forms for the same asset. The difference being Fbar is mainly accounts, and you don't have to have a financial interest in it. You could have just like signature authority. You have to file it. Form 8938 is more expensive. For example, you may have stock certificates. It doesn't go in the Fbar unless it's in a stock account. It would still be reported on Form 8938. There's various other forms you may have to file as well. They're less common, but becoming more common with the globalization of the U.S. economy. Form 5471 is for foreign corporations. You may have things like Subpart F, controlled foreign corporation, GILTI, global intangible low tax income, gets very complicated. 8865 is the partnership version of that form. Form 3520 is for foreign gifts and trusts. Form 3520-A is for foreign trusts. And 8621 is for the PFICs. PFICs are passive foreign investment companies. The reason why that can get complicated is because you're thinking, oh, you must have to have like some BVI holding company or something. No, you could have just merely invested in some foreign mutual funds because you didn't want the headache of dealing with it. And now the IRS wants to give you the headache of having to report it and pay the different tax on it that you would pay for the same income if it was generated in the US. If all of this is new to you and you're out of compliance, there's various programs you can safely use to get into compliance. If you're willful or just can't certify under penalty of perjury, you're non-willful, you would do the voluntary disclosure program. Be sure to speak with experienced practitioners. A lot of times I talk to clients who come to us after they went somewhere else and they were sold this bill of goods. They'll do VDP and then they'll claim reasonable cause and avoid the penalty altogether. It doesn't work that way, especially under the new version of the program post September 2018. If you're non-willful, there's various other programs available to you. The streamlined procedures you've probably heard about, streamlined domestic, streamlined foreign. They're both for offshore assets. It's just streamlined domestics for non-foreign residents. Streamlined foreign is a bit better of a program, but they're still both great. You've also got reasonable cause and delinquency if you qualify for either one of those alternatives. But the delinquency procedures for matters that do not include only Fbar, so if you have more than just the Fbar, they changed that program around in November 2020, and it's not as forgiving as it used to be. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to something that you have and if it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.